Okay, hello, folks. Welcome to Market Trends. I am David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. It's been a little while. Last with you back in May. I'm going to start by showing you some disclosures. And we're technically not starting for another maybe 30 seconds, so I'll just leave this up for a little bit. I think we're now hitting our official start time. So great to be with everyone. This is our normal webinar that we do on Thursdays at 2 p.m. Took off the month of June and now back in July, and we'll be back with you going forward. Um, so I want to just show you these disclosures first. Now, we do these webinars on Thursday afternoons at 2 p.m., looking at main things happening in the market and some of the ways people can use TradeStation's platform to understand what's happening in the market and to act on it. And we have all kinds of interesting stuff. Just quickly showing you these disclosures. I'm also next going to show you some standardized returns of some ETFs right here. Now we use these ETFs as indexes, essentially as kind of to measure, where the market is doing things. So I just want to show these to you. We also have an ETF disclosure page. I'm going to give you the link to in a second. Now, as you guys may know, if you go to tradestation.com, you go to Insights. This is our blog. The top article on the blog today is our rundown or summary of the things we're going to be speaking about today. Just quickly share this with you. Now, this article here, S&P crosses 5,600 is pre-April bullishness returns. Down here at the bottom, we have a link to our ETF disclosures if you want to see that. And let me go ahead and share that. A couple other things with you in the chat. So I want to just share this with you guys. And now, sorry about this. Let me just go on now with the big things that are happening because we have a bearish outside data in the S&P 500 after a very interesting inflation report. All right, now let's talk about the good stuff here. All right, now we're going to get to this in a second, but let's take a big look here at the S&P 500 because as we look at the index, we can see we now have a bearish outside day. And I think we should be aware of this as a short-term sort of issue. However, at the same time, I think it's important to realize that there's been a lot of things that have been really pushing this market upward, and it's important to kind of keep a picture, a view of the bigger sort of news. I think it's first of all, the first thing I want to talk about is the fact that if you look on the weekly chart, we make this into a weekly, you can actually see that we've had several positive weeks, and you see we get 3 positive weeks, sideways week, pause, and then continuation. Now, if you look at our article here, you can see, now this is a daily chart, but you can see we mark these periods of consolidation, of tight sideways movement. And I think this is important because if you look back at the S&P, in fact, I'm going to go to this chart. I've got all kinds of charts, and one of the ones that I think is that I've been using often is this chart, and this shows us is a few different things, but it's important that the main thing I want to talk about first is look back here in early November. The market rallied hard and had tight consolidation, no pullback, just tight consolidation, continue higher. These patterns are consistent with a lack of selling pressure. People are not selling, they're just buying, waiting, and then don't get a pullback and they just keep going. And what's interesting is the market essentially behaved this way all the way through the end of March. And then the 9-day rate of change turned positive and the market had a pullback. And it's interesting is that this period here was essentially a period of consolidation. But then when we get here, things start behaving similarly again, especially once we get to early June. What we see in early June is we see we see a push to new highs, tight consolidation, no pullback. Push to new highs, tight consolidation all the way between June 12th and pretty much the beginning of July, and now a move higher. So now what do we have? we had multiple bearish outside days if you look back here in late June, and the market basically didn't care, didn't pull back, just move sideways. Now we have a bearish outside day on the S&P 500. So I think what's interesting here is we might want to just look and see if we're going to get some sideways movement, for the next few sessions, the next chunk of time. I think it's important to realize here that we have, as you look at the overall S&P, there's a level I'm starting to watch here, which is right around 55.62. And the reason is because remember, this is Monday right here, right? This right here, this day here is Monday, and that's our weekly low. We also have the high from last week. So I think if we look across here, we can see the potential for some support right across this zone here. So I wanted to just kind of emphasize that. Now, as we said in this article, this might seem like a clumsy sort of way to title an article, but I think it's really important to understand some of these features we were talking about in the rally that had basically started back in November. Um, the first thing about it was that RSI went overbought and stayed overbought. This is what I'm talking about. This sort of pattern, honestly, it looks like 1995. We've talked about this a lot, but this kind of price action is very similar to the S&P 500 did back in 1995 when that bull run started, when the Fed engineered a soft landing. Another aspect of that period in time was that the 9-day rate of change almost never went negative for like a year. And so what's interesting here is that essentially we see the 9-day rate of change remaining very positive for most of this period of time. What's very interesting to me here is the way that it just could not go negative right back here at the beginning of July. So from my perspective, we have to just recognize these are clear, sort of objective comparisons to another period of time, which is extremely similar. Also had a soft landing, a Fed hiking cycle, all of those things. All right, let me just see a quick thing. All right, good. Let me continue now. So anyway, the other thing was the 21-day exponential moving average pretty much remaining above that is consistent. Now, also that 1995 period. So I want to very quickly point that out. Anyway, I did not put it in my notes because I'm looking at it today. And the like I said, the low of Monday, that's our weekly low, and it's not very far from the close of last week. So again, if we were to think about things on a weekly time frame, we just quickly look at something on a weekly basis. Put this one up on a weekly really quick. Sorry. See again, let's just kind of see here. Do we keep essentially maybe just a minus, you know, point 0.1 for the week or something like that? Is that what happens? Do we just have a candle like this? That I think is the important thing. And that's consistent with something of an uptrend where you make a higher low, you make a higher high, but maybe you're a little bit negative. And maybe that's what happens this week for the next little bit of time here. And I think it's just important to kind of realize we've seen these patterns before, but what's really interesting to me is that the bearish outside days that we saw after June 15th, because we saw a bunch of them, they simply did not work as reversal patterns. The market shrugged them off and basically continued to new highs. Look at this, bearish outside day, bearish outside day, bearish outside day. 3 of them here. And what the market do, it basically just held this tight range. So remember, one of the attributes also of the market we talked about is the fact that it holds tight recent lows like this one right here in early November 9th. Look at how it rallies up, basically goes back from its low from 6 calendar days before it continues. So again, this tight, holding these tight weekly lows. So now we have that weekly low in effect, and let's just kind of watch that. So that's what I want to point out first of all with this. There's a lot of things on the chart that I think are important to look at. All right, now I'm going to look over some of these. I'm going to do on TradingView, the TradingView chart, because it's a little bit easier to pull some of them up. I have some of these things marked previously. One of my problems, I will admit, is that I have too many charts and I have too many levels drawn in too many places. And I've some of the times I keep these on TradingView for different reasons. So please bear with me on that. This is the mid cap, the S&P 400 mid cap index. Look at this level from back in November of 2021. So this was holding, and now we have essentially this falling line here. Now, I think this is actually very interesting. And from my perspective here, what are we seeing? We are seeing a rotation away from mega caps. It's interesting. The last time, one of these webinars we did, I think it was back on May 26th. If you actually look back at what we said on May 26th, we said there was going to be a shift back to the mega caps. Well, here we are 8 weeks later, something like 6 weeks later, and that cycle has played out. We were talking about the things that were coming, like the Apple AI event. We were talking about the inflation report that was coming for both the one in mid-June and now this one in July. Both of them lower than expected. So basically, those things have now played out. But now we're back at a spot where we've had this really massive concentration in the mega caps. And at the same time, if we start getting lower interest rates, people can say, you know what, these banks, these smaller companies start to look interesting again. Housing stocks potentially start to look interesting again. Material stocks potentially look interesting again. The one that is highest on my list, though, are financials, and I'm going to be getting into that in a second because there was some interesting news on financials that honestly didn't get very much attention, and it was very interesting. But let me first just kind of continue with this. First, we had also on the semiconductor index today, not surprisingly, huge bearish outside day. Look, we have one of these back here. What happened? It gave us about 10 to 12 sessions, down and sideways before continued higher. And I think something like that here, let's just kind of watch and see what happens with something like the chip stocks. Look out into earnings season and be ready for them to report and realize there might be some news around those. But again, this now also is consistent with a sort of pattern. We saw like this one back here in this bearish outside candle on March 8th. Then it had a period of sideways movement, and now we have this one here. I'll also point out that what's very interesting is here's another little thing I did with TradingView, and I want to show you. If we look at the RUT divided by NDX, this will show us a ratio of the Russell 2000 to the NASDAQ 100. So obviously this has been trending down for a long time because mega caps are not performing and small caps have been weak. Now on this one, I have a rate of change on this chart. Now what's interesting is that this shows me my 1-day rate of change. And I use this when I'm writing articles and blog posts. I'm like, oh, this stock is up a bunch. It had its biggest gain in how long? I use this chart to quickly find that. Now what's very interesting here about this is this ratio today had its biggest increase since sometime back here in 2021. This was back when they had the vaccine announced in November of 2020, and you had this violent rally in energy stocks and airlines and all those sort of value names, the pandemic comeback. So if you look at this price action now in the Russell relative to the NASDAQ, it is telling us that we could be at a spot here of some more significant outperformance of small caps. And the thing is, we have been waiting for this. We've been told by all these strategists that small caps have to do well and they're undervalued and blah, blah, blah. And then it never happens. And NVIDIA keeps going up and small caps do nothing. Well, the thing is that happens for a while, but at a certain point in time in markets, things swing back. Then we have to realize there is a fundamental argument in favor of small caps based on their valuation, based on their cyclical situation, based on the fact that a lot of them are things like regional banks and stuff that if interest rates come down, a lot of those stocks have been trading at distressed levels. So the thing is, if we're in a spot where right now, when you look at the CPI data we had, when you look at what Jerome Powell said this week, right now we're setting up for the potential. The market is starting to really embrace a September rate cut. And I'm going to get to show you some more data on that, but I think it's really important to realize that. And if that is the case, this thing we've been waiting on for a long time might start to materialize. So let's just look at like a daily chart of RUT. This is on the trade on TradingView. If you want to look on TradeStation, you can just look at. I like to look at the where is it? Let's look at this. We can look at the RTY, which is the permanent. It's the it's the continuous contract for the Russell. Oh, that's the wrong one. RTY. And what's interesting for this is we have, in my view, something here that looks like a breakout of a downtrend. And I think now the question here is, we have these highs potentially in play. And I think the question is, do we get up and start closing above some of those highs from back in April and May? And I think if we do, we just have to realize that people have been watching this and talking about this for a while. And, I think this might actually be more of the sort of direction markets could go for the next few months. We have to just recognize that you can't predict something like that, but you have to think of the risk reward and realize that a lot has been placed right now on the AI trade, on that growth trade. But if we go back to the idea of a Fed cutting cycle, then that's a different environment. And in that environment, that something like the small caps and also precious metals, these are the sort of names that people could turn to based on history. And I just want to point this out because this is here a pretty significant level. So we look here at the Russell and go back over here quickly. This is pretty much the same thing. This is the all-time high in the Russell in November of 2021. So the thing is, this has some space. So I want to just point out something like this here. If we get some closes, above these levels, this could be something when people start to talk about breakouts. And so I want to just mention that this is something here that is on the charts. We did a trading view idea on this yesterday. If you look at it, there's a triangle that you can more or less see. We marked it up on trading view. If you want to see our trading view ideas, go up here to the top of the rundown and click on this link and you can see it. But I want to just mention that. Now, what's also interesting is if we look also at this thing, let me just make sure I want to make sure I have this IWD. I did not. All right. So basically, all right, I want to just, if you look at a comparison of value stocks to growth stocks, we also have a very similar sort of thing happening right now. Now, another indicator we look at, go to TradeStation platform and wait a second. We have our MT breadth workspace. Now, I didn't mention it to you guys yet, but if you go to the top of our blog post that I just shared, if you go to tradestation.com, you go to insights, you go to that top blog post, there's a link to it in the link that says the materials for today's webinar, and then you can click on that, and it has a zip file, and if you have TradeStation running, you can import the ELDs of various indicators, and then you can import the workspaces, and the workspace that I'm now looking at that is in that zip file is this one, MT breadth. This shows a few interesting things. First of all, I had not even thought of it. Let me get to that in a second, but look at this. This shows a number of stocks making highs in the S&P 500. So this is spiking higher as new lows goes lower. This shows a number of companies above their 20-day simple moving average. Look at this. The S&P is down almost 1%, right? Like 0.9% or something like that. And we have the most companies crossing above their 20-day moving averages in month and a half, almost 2 months, and it's spiking up. We have the most 52-week highs today. We're at 50, and that's the highest since also this period on June 18th. But the index is down like almost 1%. This is actually a pretty crazy day. I gotta just say, technically, this is pretty interesting stuff. So we're seeing here this real ramp up of new highs. Stocks crossing above the 20-day simple moving average in a negative market. This is improving breadth. Now, another thing, let's just look at the advanced decline line. I want to just see because this is, I don't know if it's an all-time high yet, but it is getting there. So looks like the all-time, looks a little bit below that, but the advanced decline line is improving. So again, what are we seeing? This is all consistent with what I just said about the small caps, which is essentially NVIDIA has been carrying the water and now a bunch of other stuff is carrying the water. And that is, I think, something that we need to see. This market we are in, probably a growth market still, is a secular bull growth market, but there have been flashes of small caps and value outperforming and having these value rips, as some people call them. And I want to just point out that this is something that can happen. And if the pattern has happened repeatedly over the last several years, and we could be at the beginning of another such pattern. So I want to just emphasize that this is these are based entirely on the things we're seeing on the charts. Now let's go over here to our MT main. And you guys all have at this one as well in the zip file. Let's go to the price grid. Now, I imported the S&P 500. You can do that by going data, add symbol list, S&P 500 index. In fact, let me show you really quick. I'm going to do that so you know how to prepare for earnings season. Go to earnings dates, click on data, Ad symbol is S&P 500. Now this is going to load upcoming earnings if you want to see that, because remember, earnings season gets going with the banks tomorrow. Let's look here at price grid. Something really kind of crazy, really unusual. Now, click on net change and let's look at the positive ones. Let's rank. Now look at this. I have now these on the side. I have reference rows added. We have now 400 members of the S&P 500 are positive today. The index is down 0.88%, but 80% of the stocks are positive. What does that tell you? What's really interesting is if you actually look back at a blog post that we did, it wasn't that long ago. It was one of these. I think it was this article right here. We had just the opposite. It was something like on the week, we had something like 200 members up and the index was up. So this is now, it went to an extreme mega cap over concentration back here. Let's see when this article was. Then we wrote in here that 61% of the members lost value, right? So there you go. It's just kind of interesting to see that. This was back in the week that ended, I guess, July 5th. So this covered the 4th of July week. In that week, we had the market going up almost 2%, but only 40% of the companies advancing in the week. Now, on a day, we have the market down almost 1% and 80% of the members up. So again, rotation, and we had reached a point of extreme mega cap concentration, and now with earnings season coming and the Fed potentially moving in a dovish direction, those things are coming together. So this is important stuff I think we're seeing here. All right, now let's take a look at yields. We've talked, ad nauseum about the 10-year at the 432 level, which goes back to June of 2008, the beginning of the financial crisis. We had basically talked about this long-term level that was resistance here, the summer of 23. Then we broke above it, and this was back when the market pulled back before it started rallying. And then you can see this resistance level set in. We crashed down. This was when the bull market really started for stocks. And I've talked about this a lot at the time. And this was when we saw the market start to behave the way I mentioned on the S&P with the tight moves and in continuation. So anyway, what's interesting here is, what do we see? We see basically it came back, stalled at that level, tried to build support at that level, and now breaking down potentially through that level. So this is a big level. Now there's another one that this is on TradingView. It is US02Y. This is the 2-year note. Look at how this has made lower highs as well. Now, this is the 2-year Treasury yield. And again, this is more sensitive to Fed policy. You might call this a head and shoulders potentially. I mean, I'm not a big fan of head and shoulders as a pattern, but we do see here, this is a reversal essentially pattern, because we have a high, we have a slightly higher high, and then a lower high. And it's like essentially, now what's also interesting, I'm trying to see what, all right, here's another thing. Look at this. This level here goes back to June also of 2007. So again, all these things are kind of leaning or pointing in the direction of rates going lower. And I think this is really important to see. Paul Tudor Jones, about a year ago, he said that the Fed, the market will express its real expectations of the Fed in the 2-year yield. That's what Paul Tudor Jones said on CNBC. And at that time, interest rates were shooting higher last summer. But it was something to think about. So now we're seeing a pretty significant drop in the 2-year yield. All these things pointing in that direction. All right, now let's go back over to let's look now at MTES. This is something we include for you guys. This is a potential, potentially maybe a signal that is potentially bullish. And what is that? So this has 3 indicators. This is our MTES workspace, also included in the zip file. It has MACD, it has stochastics, and it has this custom indicator called MA speed. It shows the speed of the 50-hour moving average. So what's interesting here is when two of the three signals um, go in one direction, it's a potential signal. So what do we have? Stochastics are oversold. That is a potentially positive signal. We also have the fact that the well, it's interesting. Now the 50 hour is actually falling, but you have a pretty significant, rise in this. So I want to just kind of point this out. Like I said, this is something where we have this bearish outside day and some potential kind of chopping here. But to me, it's interesting to see this significant drop in stochastics when you have the context of this uptrend. This is now something that's pointing at a point. I mean, this is a pretty oversold condition when you consider the fact that we're hitting new highs. So again, like I said, the S&P here, that weekly low, the Monday low, the high of last week, we kind of watch here. And if things stabilize here, this is actually a spot where some people might say, you know what, there's still, we're not making new lows. There's momentum. It's a significant short-term oversold condition, and that might be something where trend followers think about kind of some continuation. All right, so those are the main technical things I wanted to show. I showed you how the RSI and the 9-day rate of change. Now I want to show you some other interesting sort of points. I showed you this 2-year. All right, this is the CPI. This is the Consumer Price Index. This is Fred, which is like my favorite website because it's like pure data from the Federal Reserve of St. Louis. And what's interesting here is they basically, here you can see, now I changed this to, I went to edit graph and I changed it to percent change, okay? If you know, otherwise they'll just show you the index as a raw value. But this was the biggest drop since it was in May of 2020. It was down a little less than 0.1%. This is, a big news. This was the big news today, obviously, as I think we know now. Now, but let's look at some other stuff here. In my view, like I've said, everyone has been waiting on shelter costs to come down. And the reason, because shelter costs are about 35, 37% of the actual consumer price index basket that is used to calculate inflation. And it's also one big thing. And we also know that the housing market has been frozen. There has not been inventory and people are stuck in homes because they don't want to, go to a higher mortgage. We all know this, right? This is a commonly expressed thing. There's a lot of data from different people showing things like this. The last few months, we have seen a slow and steady drumbeat of basically increased activity in the housing market, people putting more houses for sale, cutting prices, inventory going up. There's been a lot of different sort of rumblings on this. And here we are now, suddenly seeing a big drop in shelter costs. So the thing is, we have known for a long time that this should be happening, should be in quotes. But the data, on one hand, we had a lot of anecdotal data and we had a lot of like real-time market data that was telling us something. But now we're getting the official data that is starting to confirm it. So the question now is it just 1 month? Or is this now something that continues? And I think if you look at the way this sort of data behaves over time, there's a chance that we're going to see an ongoing decline of shelter costs here. Excuse me, as people, oh, I want to move, and I put my house on the market for like 500,000, and no one's buying it. I'll go down, and then I got to move. I got to get this house done, and then you end up cutting the prices on those houses. People leave apartments and those rents start coming down. There's been evidence of all this kind of coming together if you just look out there in the news. And so this is really, something here that if this is going to be happening. And the other thing is, if interest rates do move down and people start moving more and wanting to move and wanting to buy houses, then that process I just described is going to accelerate, where people say, I got to move. I got to get rid of this house and move to my other one. And as that happens, the market will unfreeze. And as it unfreezes, there's a chance that it will resolve toward lower inflation and lower shelter costs in the CPI. And when you consider its weighting in the overall CPI, what does that mean for CPI 6 to 12 months from now? What does that mean for Fed policy 6 to 12 months from now? And then what does that mean for bank earnings 6 to 12 months from now? What does that mean for small caps 6 to 12 months from now. And that is the calculus that is now going through the minds of all the big investors looking out there and thinking about what is the market going to do going forward. And I think that's one of the things that we're potentially seeing playing out. So this, I think, is a really important chart because we've known in air quotes that this is going to happen. This has been a really established expectation among economists, and now it might finally be happening. So this is something that is interesting. I think it's interesting. We had the inflation surge 2 years ago. Everyone said, "Oh, when it ends, we'll have a great market." And then this AI thing came along that a lot of people maybe didn't expect 18 months ago, and it just dominated the world. But then it's like, wait a second, take a step back. We have that other narrative that is out there of falling interest rates, of lower inflation, of banks coming back, of housing. That narrative just took a vacation. But with today's data, it is potentially coming back in play. So want to just kind of point that out. Let me continue now with the next thing. The CME has this Fed Watch tool. This is the September meeting. Now pricing in an 84% chance of a rate cut in September. So you can I love looking at the history of this. A month ago, it was 47%. Now it's 84%, 85% probability. This is based on futures, not anything certain, but this is kind of like a weather report. 2 weeks in the future, it's not right. But the closer you get to the event, the more accurate it tends to be. So as these things kind of come together here, what's also interesting today is we had Mary Daly at the San Francisco Fed. I think she's a voter. Yeah, she's a voter. She basically said, with the inflation we've received today, which includes data on employment, I see it as likely that policy adjustments will be warranted. And then she said 1 or 2 rate cuts this year could be kind of appropriate, the way she more or less said it. Jerome Powell this week basically was talking about the potential risk of keeping rates too high. I mean, in my view, he's now laying the groundwork for what people might call a Powell put, where basically we could be in a spot where if the economy weakens, then he has the ability to cut. And I think that's just important here to kind of to realize that this is now becoming something that is more confident. It's really interesting. This is actually an article. Let me show you this thing we had done on very quickly. We did this article. All right, this was a kind of funny thing we did on our Twitter feed back in June. But we basically talked about how the inflation story was dying. This was basically a month ago that we were really talking about this inflation narrative coming together, and it has kind of panned out as we had kind of covered. But here's an article we did about the bond market could be looking past a hawkish Fed. We did this one like a month ago, but essentially we were talking about was that at the time, if you look at this on our Twitter feed or X, you can see we went through a lot of things that were showing, a sort of expectation of interest rates, of weakening in the job market that has played out, as things have happened. Another one we did back in June was this report on all the money. This is the money market funds, the cash and money market funds, and this idea of there being a potential wall of money, which is actually something that a strategist had said, and we talked about it in the article. But I want to just point this out. These are some of the things we have put up recently, and they've been more or less playing out. So the thing now is that, all right, now that all those things have kind of happened, the narrative then still pivots back to essentially what happens if we really do follow through on the rate, on seeing rates move lower. And when you look at some of these things, like, for example, the Russell or the mid caps, or the other one is the banking the what is it? I'm sorry, the KB. I have the ticker here somewhere. It's the I think it's a BKX on this. This is the Nasdaq Bank Index. Again, if you look at these things over the long run, these have not done very much. And when you look at something like Nvidia and you look at the big tech stocks, so I think right now we have to just kind of remember that these are areas that potentially have that logic of benefiting from interest rate, interest rates moving lower, and the fact that they haven't done much for a long time compared to the other parts of the market. All right. Now another thing So these are the ones we want to cover. This is another article we did that was kind of interesting. If you want to look into it, this person at the beach, we did it back on July 5th, I think. But it was interesting because we kind of showed how to use some of easy language and some of TradeStation's functionality to really dig in and analyze the market. And it turned out that we've gone a really long time without a 3% pullback. And I break down how to do that with the coding in here. You actually click through and look at this article. But those are things I wanted to mention. The fact that we've seen that the market kind of was behaving already, that inflation was going to ease. We mentioned that the Fed came out and they went from 3 cuts to 1 cut, and then the market went just the opposite way. And one of the points we make in this article at the time was that if you go back to late 2021, right, and early 2022, Powell was like, "Oh, inflation's transitory. It's not a big deal." And the market's like, "It's a big deal." And they were cranking rates higher, and the Fed was having to play catch up, as we probably all remember. But now, what's interesting is, in the last month, the market has done just the opposite. The market was pushing rates lower as Powell was out there being hawkish. So it's really interesting to just kind of see this, and I think it's actually a bullish thing because as you look overall at the markets when they surprise to the upside, we're in that stage that people keep getting surprised in one direction. That is when money can still come off the sidelines. When everyone, like JP Morgan said, when the shoe shine boy gives you stock tips, that's when you want to sell. But when people are still surprised, like, wow, I can't believe the market's still going up, I can't believe that inflation's getting better, that is when there's still people going from the I'm scared to I'm a believer. And that's exactly what the point of this blog post was it basically there's all this money sitting in money market funds, and as it starts to shift. Now I'll point out that this data point, for some reason on Fred, if you go to Fred and you put in like Fred retail, it's funny, they don't update this regularly. The last update we had was actually June 3rd. So it'd be interesting to see. What was interesting, if you look at the data back in June, was it basically it was moving sideways and it hasn't done any. I mean, we haven't had an update, and then they might just update it all like several weeks in one shot. But this could be moving lower. But I think it's just interesting that it had stopped rising at this point in time. All right, so those are some of the main things I wanted to show. Let me just look at some of my other notes. All right, another thing. All right, what was interesting today? Delta Airlines. You know, my I had someone coming to visit us, and basically he said, "Oh yeah, my plane ticket like just went down like 40% in a week because he like bought it." What's interesting is Delta Airlines. He told me that a day or two ago, and next thing I know, look at Delta Airlines today coming out with a pretty ugly warning. And what are they saying? They're saying we can't raise prices. We're getting squeezed on pricing or something. Well, you know what? That is good for core services, inflation, things like that. Also, auto insurance was starting to slow in today's CPI. I mean, shelter was a big one, but auto insurance starting to slow. So as this thing trickles through, airlines are, that is part of core CPI. And as we start to see companies like Delta Airlines complain about their inability to raise prices, and at the same time, you hear these anecdotal things of prices coming down, and you hear this is also consistent with the narrative. Services inflation. Everyone's freaked out about services inflation, and then what do we get? We get transportation services coming down. So, pretty interesting. There's another article. If you Google and you look, an article came out from Reuters 2 days ago, and it talked about how the Fed might change a rule on something called the GSIB surcharge. Remember, too big to fail. A bank is too big to fail. It has to hold extra capital. The mega banks. So basically, this impacts companies like Bank of America and some of these. And basically, according to Reuters, the Fed might ease those rules, allowing more capital to be released to shareholders. Now, again, these banks have been highly capitalized. What's very interesting, I want to point out, no one talks about banks like UBS and Santander, but these European banks, I mean, Europe has not been doing great. And these banks have just been, I haven't actually looked at Santander recently, so let's see. I mean, it's been in a longer term uptrend. But what's interesting is, I mean, at least for a while here. Anyway, my point is that these European banks got overcapitalized when they, coming out of the financial crisis, and American banks have been in something of a similar place. So the thing is, even if we have something of a slowing economy, and we've seen some of that, the GDP estimates have come down. A lot of those things have come down. But the thing we have to remember at these banks is that they are still basically highly capitalized coming out of the financial crisis. Also, Americans, there's an article, I think if you look at the CNBC article this week about mortgage applications, record $17 trillion of home equity. All right, so right now, mortgages, if you originate a mortgage now, you probably have less risk of that mortgage blowing up because there's equity in these homes and things like that. So I think that's the other thing that's out there. The other thing is people have not been doing cash out refis. What happens when that starts to happen 6 to 12 to 18 months from now? All of these things are potentially going to open up the doors to, increased activity for the banks. So I think it's interesting to remember Wells Fargo reports tomorrow. Some of these other banks report tomorrow. And I think it's interesting just to look at this here and to realize that we have here, a stock that basically has now moved sideways, for like 3 or 4 months, that is in an interesting uptrend. The same sort of thing about a name like Citi. And so I think the question is here, it's like, all right, it doesn't just have to be NVIDIA. It doesn't, I mean, there are other stocks aside from them that have potential fundamental stories here. And I think it's important. This article on Reuters got like zero attention, but if you Google it, it was on the 9th. Just Google, Fed, something about the GSIB surcharge, and you'll see very interesting. These guys start reporting earnings soon. So that's another part of this sort of shift toward value stocks that we're seeing here. Another point is China. That's right, China. We saw some unusual options activity in Baidu. And I started looking a little, and I realized there was some other stuff happening. So the Chinese have this thing coming up called the Third Plenum. It's some kind of Communist Party thing. And there's this sort of expectation that they might announce measures or something like that that could potentially be supportive of their economy. At the same time, the other thing I point out in this article was that CPI could potentially weaken the dollar, and that can be good for global assets. So the first thing did happen. The next thing's coming up next week. And the other thing is Baidu has some kind of AI trade with some kind of robo-taxi. I want to just point this out. If you look at this thing at China next week, China has been completely out of favor. There's obviously political issues and things like that with it. But at the same time, we wrote about this back in April. If you look at this article, that we actually have here, is that basically the Chinese started getting much more market friendly back in April. So they really came out I think it was the beginning of 2021, and they started like cracking down on companies in all kinds of ways, making it harder to list stock and all kinds of anti-business things. And they did it for a while, and Chinese stocks really got hammered for like 2 years. But what's interesting is early this year, they sent a lot of signals that we want to be friendly to investors. And I'm not sure why, but they did. And to see that happening, and now, they have this other thing coming up next week. These pieces coming together, I want to just point that out. These Chinese stocks are highly active. They trade a lot of options, some interesting names here, and they've gotten really smashed lower for a long time. So I want to put that on your radar because I think a lot of people right now are not thinking about the potential for, some kind of potential recovery in Chinese stocks. All right. Now, some of the other things that were out there, I think I covered all of these things I wanted to do. Yeah. Let's just go back over now. And I just want to mention the ones that wasn't really grabbing my eye was Amgen. And I just got to say, this is a stock that has, been, they've had some interesting news here. And, repeated, a lot, consistent, repeated or multiple gaps higher on earnings, like this one here. They had another one back here somewhere. And then what was interesting was this fell because people said, "Oh, we think that it's we're worried." Are you looking back at the articles when this happened? we're worried that they're not going to do well on weight loss. You see these things sometimes when it's like stock falls on worries, and there's nothing else. It just people say that, and then um, it just you never hear it again. And so this is remember the Dow. They report earnings relatively soon. I want to put this on people's radar here because we are seeing some strength in biotech in the market here. Healthcare has been really out of favor, but again, this is an area where as earnings approach, names like this are kind of I think going to be on people's radar. Some of these other Chinese names that were interesting was I wanted to just mention a name like this company Billy. I don't know much about this. It's some kind of e-commerce company, but it has been rallying this year. And it's just another name that kind of popped up as I was looking at these Chinese names recently, had some unusual options activity. But these are some of the interesting things that are kind of surfacing. Another thing that could potentially happen is names like Zillow. Um, right now, you know, as if we see increased activity in the housing market with transactions overall, a name like Zillow is the sort of name that could potentially benefit from that. So I want to kind of point this one out. Is really just kind of beat down here, nothing really happening, but it's something that is sensitive to this kind of overall housing market. Now you look at the overall home builders, and I think the thing about the home builders here we have to remember is that one of the reasons why they had rallied so much was because they didn't have any competition from existing homes. New homes have taken up a huge share of the market, and I think was one thing you have to realize is they're going to start competing with existing homes and existing home. So some guy bought a house for 300,000. Now it's worth. He lists it for 500,000, and maybe he cuts it to 450 to sell it. He's sitting on equity and gains. So for him, if he has to take something of a haircut so he can move, then he's willing to do it. But for a home builder that they list a house for 500, now they have to knock it down to 450. That's not really a great thing for their earnings. So the thing is, they are competing with equity-rich sellers. And I think that they have not had to compete with existing homes for a while. The real narrative and driver behind the home builders was that they did not have competition from existing homes, but now they do. So I want to just point that out. Assuming the home builders here, it's a little bit of a. I mean, today you get this big rally based on the CPI news, but I think it's also important just to realize that there was a certain narrative that lifted home builders and made them outperformers for a while, but that narrative is actually not necessarily the case. And as things play out, it might also, to a certain extent, get worse as more houses go on the market. So I want to point that out about the home builders. All right, those are the main things I wanted to point out. Let's see if we have any questions. I don't think I see any questions so far. Is there a recording for the Options Play webinar? We spoke with Options Play, and I'm not sure when and how that will be shared. I think if you check our YouTube or their YouTube over time, there's a chance that they'll post it, but I'm not sure on that. This webinar is live streaming and it will remain live on YouTube and on X. And actually today we're on Facebook for the first time, so hopefully that's working out if you're on Facebook. All right, now those are the main things I wanted to cover, but let's quickly look here at our price grid because like I said, it's interesting to see here, we have new stocks hitting highs. If you want to see that, you can look at something like distance from 52-week high. And this will tell us when it's above zero, it basically means that today's high, it looks at today's high versus the 52-week high as of yesterday. So basically anything here that's a positive number means that it's hitting a new 52-week high in the current session. There's a way to start identifying some of those names. Now, we look over here at the earnings dates, which I shared with you. This allows us to prepare for earnings season. One of the tricks I like to do with this, or one of the hacks, is I like to basically sort it by average options volume. I'd say let's only look at stuff that trades maybe 20,000 contracts a day. So I go down here and I go to data, add label row, and it will break that off. Then it separates those, and now I can sort by days to earnings. And what do I see? I see basically Bank of America. I see Goldman. I see Wells Fargo tomorrow. So we can see here Citigroup, JP Morgan, and Wells Fargo tomorrow, and then these big banks next week. So I want to just kind of point that out. This is where the focus is is right now. All right. There was also some interesting articles about refining margins. So refiners, BP apparently had some bad news, and the other one was PBF, not a widely known company, but it's another oil refinery. If you look at these other names, the big names in the refinery space are Valero, which is VLO, MPC, and PSX. Now, these names have all been doing poorly. And there's been a lot of news about, oh, we don't have the pricing power that we used to have. Margins have been weak. Well, again, that's another thing that is not bad news if you're Jerome Powell and you want to have inflation move lower. So I think it's just kind of interesting. I wanted to kind of mention that that seeing this weakness in the refineries is also a sign of slack in the economy. Another thing that is interesting is that Ed Yardeni raised just today. He raised his S&P forecast from 5,400 to 5,800. I wanted to just kind of share that. I told you about Mary Daly, and what was the other thing here? Yeah, those are the main points I had saved. So this is how you can use the earnings thing. And now let me just look at our calendar of upcoming events, and I want to end by showing you how to use the breakout from X bars. So these are the main things here that are. So Oppenheimer raised their target to 5,900. Tomorrow we have PPI. Not sure how important it will be following the CPI today. I think the thing that's going to be interesting next is retail sales. If that's something where a weak number, also could build on the case. At this point, I mean, I'm not sure it's really massively important one way or the other. When we came into this month, we were kind of saying that the things that are attention is most likely to focus on was going to be Jerome Powell in the Senate and CPI. And so now the macro story is there. And now we have earnings, and it's only going to intensify from there. After this, next week we have more of the banks and stuff, and then we start getting into the big tech names. And again, you can use the earnings tab in your MT main workspace to see that. But like I said, the earnings really start cranking, especially the week after the 18th. As we get past it's that following week. So these are things on the calendar, but we have this Chinese thing next week. So maybe just kind of see if any headlines come out of that, and just kind of look at some of these the potential things to see if anything does kind of come together, because it's like small caps. The sentiment gets so bad and people say, oh, they'll never go up. They'll be terrible forever. And then suddenly it becomes a dash for things to like kind of come back. So, that can happen in markets like this. Very often in bull markets, what you see is that the thing that is doing well, it will pause for a while, and then you'll get these dashes to other things. And so, we've had this significant run in the large caps. And we have also the pattern of the bearish outside day on the semiconductor index, on the NASDAQ, on the S&P 500, and this sharp pivot in relative strength. Okay, now let's look at this thing called breakout of X bar high. I'm going to end with this. This is kind of useful. Actually, I think I'm going to just open up a new workspace really quick. Now, I'm just going to go quickly to chart analysis, and I'll pull up a radar screen as well. Do a quick radar screen. All right, so my computer is suddenly going slow, and you gotta be careful sometimes when you're live streaming. It can be a little. I'm gonna just kill this up here actually. So anyway, I'm gonna kill some other windows to free up a little memory and just quickly zip through this until we're done. All right, so I'm gonna now go to a daily, and let's look at something like the let's look at a name like Goldman. They report next week. Let's take a look at them. All right, now we'll look at the daily. Now go to studies, add study. Now, this is called a show me. A show me is a study that only appears when an event happens. An indicator is always there, like the 10-day moving average or whatever. It's always going to plot. A show me will only show you something when the thing happens. So we're going to go to breakout of X bar high and hit OK. Now, by default, it's going to have 14 days. So what this is going to do is this is going to highlight when things hit that 14-day high. And there you go. Now, what's interesting is that things, when they're range bound, will often kind of, they'll be going and then they'll suddenly start hitting those highs, and then you get potential continuation. And that's the way that something like this can work. So, the 14-day period is potentially not going to work on all setups. The period of time could be longer or shorter. But by seeing these, and I'm going to show you how to find them in radar screen, it can start turning your direction to things that are, wow, maybe your attention, maybe this is starting to do something. So what's interesting is I think it was Amazon. Look at how once it started making, see, it made these highs here, but see, it started, what I look for is I look for like high closes. And then this was the highest close in like over a month. And then you'll often get, it'll touch it, you'll get one more pullback, and then you get the continuation. This is how I've often seen this play out. You'll get a weekly high close. That's another thing that I've written about a lot. It closes at a weekly high. It sits for 3 days. You think, oh, it's done. And then boom, continuation. That pattern can happen. So something like this indicator can help you see those. So this is something here on like Amazon. And I'm going to just quickly go over here. I'm going to bring in like just bring in the Dow, have a nice short little list. I'm going to change it, select all, and then go to time frame daily. We're going to go to studies, add study. And I'm going to go to, also, now we have to make sure that we're choosing a show me and not an indicator. Show me. And then we're going to go to breakout of X bar high. I'm going to go ahead and just add that. I'm going to quickly give it a bigger font. So you can see better. I'm also going to link these so you can see. All right. Now, what will this tell us? This will tell us now, and we only really care about this column right here. This will tell us stocks that are hitting a 14-day high. You click on it here and they'll pop up over here. You'll actually notice, you can see. Let me just kill some of this. But when markets start sneaking higher, these are some of the patterns that you might start to see here. 3M has been something of a turnaround name, but Johnson and Johnson here. Let's see what we're getting. You see, I'm just pointing. I hadn't even looked at these yet today. It's an unusual sort of day, but again, this indicator is, if you're looking for things that might kind of, sneak higher, start to move after a period of being kind of dead in the water, this is maybe something that people can kind of look toward. I mean, just curious, because I just started looking at like Zillow today, but look at a name like this was hitting that new kind of high. And if you look at some of these other areas that were starting to move, like GDX, the gold miners, see how it started hitting these highs? We had actually done a trading view idea on NEM, and it really kind of continued higher. It basically hit that high. That was actually like a multi-year high intraday, and it got stuck, and then tight consolidation, and then look at how it front ran the CPI. This is this gold mining stock. I want to just kind of point this one out. We had done a trading view idea on this. It was this flat line across here, touch it, tight consolidation, and then continuation. So these are some of the patterns of ways people might look to use something like this. Again, it is called breakout of X bar high. There's also one for breakout to the lows as well if you want to look for that. So we'll be back next week, same time. It's great to be with everyone, and see you then. And just go ahead and check out tradestation.com. Go to the Insights tab and look for more things that we're going to be doing on our blog. Hope everyone has a great day, and I'll see you next week.